Ankit Agarwal, the Managing Director. Ankit, let's get straight down to it. 100 plus crore profit a year ago, now consolidated net loss of 20 crores. What exactly is going on when we look at the earnings? And I want to focus with you on margins as well. Yes, the revenues have gone up. You've seen bit contraction, expansion in the margins, but nowhere close to historically what the street is used to. When will that happen?
Absolutely. So, firstly, thank you for having me on the show. As we spoke in the last quarter as well, I think the primary focus right now has been in terms of our focus markets on the optical side, both in Europe and US. So, I think that's panning out quite well for us in terms of both current revenues as well as order booking that we've seen. What we shared also last time was that we do continue to see cost inflation, particularly linked to container costs going up, which have gone up broadly from about $7,000 to about $22,000, particularly as a lot of our shipments have started increasing from India to Europe as well as to US. We've seen some normalization of that, probably around $16,000, $17,000, but still some way to go to counter that. The second part is some of our raw materials also linked to the oil prices, which have of course gone up from about $60, $70 to about $110, $120. So that's something that we're also watching closely. And then we've had other raw materials like helium and other gases, which have also seen some abnormal spikes. So we are confident that we'll be able to pass on some of these cost increases to our customers, both in quarter one, and we should see more of that coming through in quarter two and quarter three. And as those come through, we do believe that our profitability levels will improve. In addition to that, we've also continued to invest significantly in our R&D, both on the wireless business and software business, and we'll continue to evaluate in terms of the prudent capital allocation towards those businesses.
What about the multiple headwinds that actually exist on the cost front for STL? Despite that, you managed to increase the margins on a quarter-on-quarter basis, and now our viewers have the explanation on why that exactly has taken place despite the consolidated loss figure of 20 crore rupees.
So we've definitely
How
seen
much of the cost benefit will you carry on?
Yeah, we've seen a good improvement, particularly in the optical business. As I said, we've seen some good improvements in terms of passing some of our costs, particularly to our US customers in the range of 7 to 10%. And we're continuing our conversations with our customers in Europe as well. So I think that's ongoing. I think on the services business, which is very, very important, we have been looking at both India market and now the UK market. And as we stated earlier, we're very focused, instead of driving top line, focus on few accounts which are giving us the right profits. So we recently also announced an order book of almost 250 crores in line with that.
Right. Mr. Agarwal, if you could just tell us that, the initial answer that you said about the margins and how the way moves ahead, that, H2 can be better, order book is looking decent. Can you just give us more tailwinds for the margin? So one, of course, is commodity coming down. Second, of course, is a lot of businesses expected to come from 5G, various other spaces. How does all of these tailwinds translate into any number, if you could put it?
Sure, absolutely. So what also in line with what we've guided to the market, one, I think just to add in terms of tailwinds, we also see a growing mix from a geographic perspective towards US. We have close to almost 14% share now of US. So that's a big positive for us. The second one is what we have, the optical interconnect solutions. These are end-to-end solutions that we have of cable and the passive components. As that ratio keeps on increasing, what we call attach rate towards 20-25%, I think that will also have a significant improvement in our margins. So directionally, what we are confident of is that our optical business will move towards 20 to 22% EBITDA towards Q3 and into Q4 in terms of exiting the year. And our services business, which is in low single digits or mid single digits currently, that will improve towards low teens. And so directionally, with both of this, we do believe that we should be at 14 to 15% EBITDA margin by the end of the year.
Can you just talk to us about how important are 5G auctions, the way things are moving on the technology side, and how is your company keeping up with all the changes? I mean, y'all are a play on 5G, how things are moving, what's happening in China. So how much are you investing back in OPEX and CAPEX, and what essentially does this important auction or this important change in the technology mean for the company?
Sure. So I think it's a phenomenal opportunity. I think it's a once in a life opportunity for STL. We believe that 5G will be globally a massive investment for the next 4 to 5 years. North of $300 billion will be invested, and I think that for us we're clearly seeing this as a global opportunity, not just in India. And we're very well placed in terms of all the investments we've done, the teams we've put in place, as well as the R&D which we've done, which we have now more than 700 patents. A lot of them are applicable towards the networks that will get built in a 5G environment. In India as well, as we're now getting through into the auctions and we'll start building 5G networks over the next 3 to 4 years, our own view is that we will probably have 2 to 300 million subscribers over the next 3 to 4 years. So it's a tremendous opportunity for STL because we actually end-to-end integrated, starting from the fiber cable connectivity. We have the virtualized OLT, ONT, and we have the software systems. On top of that, we have ORAN compliant radio units. So I think we are very well set up to cater to these requirements, and we're already in conversations with operators both in India and globally across our portfolio. So I think it's a tremendous opportunity. And I would just reiterate one thing, that as you go more and more towards 5G and you need significant more number of small cells, each of these touch points need to be connected 100% by backhaul with fiber. So I think that's also a very, very large opportunity with us, because we do see the fiber demand globally, not just in China, but globally continuing to grow for the next 4 to 5 years.
Right. Ankit, would it be fair to say that STL is currently in a multi-year network build cycle, as analysts are terming your company to be? Because as of now, 27% of your revenues are coming from India, with the balance coming in from overseas, both Europe as well as North America. What shape would STL take going forward?
So we continue to be very positive on India as well. As I said, the huge network needs to get built in India. Both for telecom operators, which we clearly see for 5G as well as fiber to the home. More than 30-40 million homes will be connected very soon. On top of that, we do see that very, very strong focus from defense and Navy for them to upgrade their networks. And at the least, we also see that BharatNet will be a massive network build out. Probably north of $10 billion will be spent on capex and opex to build that network. So there's enough opportunity for us in India. But the way we build the business, the way we look at the global opportunity, I do expect that probably some ratio of probably 70% of our business being global and 30% of our business being in India going forward.
Right. Ankit, great to have you on the show today and speak with us about where STL is headed next. Good chatting with you on ET Now today.
Thank you very much.
Okay.